Thank you all for coming. Up you'll see our agenda on the PowerPoint here. We'll go from a 6 to 7 or so on the blockchain presentation. Then we'll open it up for a Q&A for the next half hour. And then we'll take a short break and have the second presentation on strategy. So at this point, I'd like to introduce Nick DeAndrea. Nick is the head of smart contract development tools for Truffle Suite, the most popular collection of tools for building blockchain applications. He's also the creator of Truffle Debugger, a widely used smart contract debugging utility. He's the author of EIP 1123, Revised Ethereum Smart Contract Packaging Standard. He's appeared as a guest on the Smart Contract podcast. Nick has also given lectures and run workshops at universities and blockchain events around the world, including Tsinghua University in Beijing, the top computer science university in China, and of course here at WPU. He has also spoken at blockchain events in Shanghai, Berlin, Portugal, Philadelphia, New York, and Portland. He also has an upcoming workshop in Prague at the annual Ethereum Development Conference. I'd also like to thank Nick's proud mom, Professor Miller, for helping to organize this visit. Please welcome Nick DeAndrea.
Thanks for having me, Peter, and everyone. Thanks for organizing and promoting the event. It's quite a good turnout. So I'm going to talk about blockchains today, whatever those are. How many people have heard of blockchain or the term? Okay, it's different from a year ago. So blockchain is technology that is used to power the Bitcoin network and a couple other cryptocurrencies. But in, I guess, the recent year or two, people have found that blockchains have been useful in a wide variety of applications in both like public blockchains making new currencies, and also in the private sector to do things like supply chain logistics. So I'm going to talk a little bit about how that relates to accounting and finance specifically, because I imagine that's the audience is mostly business students tonight. But first, a little bit about me. So I'm, as Peter explained, I'm the head of smart contract development tools for Truffle Suite. But none of you are software engineers, so I won't get into that. I work on some standards documents and kind of just participate in the community, making it possible for people to build on these systems. You can reach me on Twitter, GitHub, or by email if anyone has any follow-up questions or anything. If anyone wants to follow along, the presentation is available at this link. So to start tonight, what I'm going to do is I'm going to go over the key concepts, like what is a blockchain, what's distributed ledger technology is another term I've been hearing a lot lately, and then kind of get into how it works in business and in finance. And then I'm going to talk about the cool futurist stuff. So what is a blockchain? Everyone's confused? I hope I'm confused. So a blockchain is a distributed ledger that's verifiable and in fact verified by all participants. And it's maintained through a shared competing interest. So you have multiple parties that are working for themselves, and the result is everyone's agreeing with each other. So that's pretty neat. What a blockchain looks like, blockchain, the word refers to a data structure, like a database or something. It just stores data. And it stores data by having a list of blocks. There's a first block that they call the genesis block. And then each block points to the one before it. And that's how it's organized. They're sent across the network like this. We'll get into that. But each block contains some transactions, like transferring Bitcoin to your friend or participating in the supply chain, which I'll explain. So if you look at a particular block, it has a bunch of data. It has a height. So you see the height's just the block number. But the block is really identified by this thing called a hash, which I'll get into. And it links back to the previous block called the parent hash. And then it has all these transactions in it and a bunch of other data that's not important for this conversation. If we look at an individual transaction, it also has a bunch of data. This is kind of similar to what you'd expect in an accounting ledger. You would see a from and a to, an amount, and some data. It's not a double entry system, though. There's no debits and credits. It's not necessary, it turns out, because basically really all you need to know is who is sending how much money where and when. An important part of this, though, is the signature. Right? If you go to the bank and you tell them to transfer money, they're going to want to make sure that you are who you say you are. And so every transaction is signed by the person, the from, and that's what mean, like, by signing it, you're authorizing that transaction to take place. So you can see a failed transaction. It's also a transaction, but it just gets ignored. Someone will go through, like, the network will look at this transaction and say, oh, this person doesn't have 6.48 whatever ether, so the transaction won't propagate. It'll get the status failed or error. But it's still signed, and I'll explain that. So if you think about each block is just a bunch of transactions, and these blocks are linked together, that's just a ledger, right? A ledger is just a list of debits and credits, one after the next, and you can use that to figure out anyone's account balance. You start at the start of the ledger, and you just go through. I sent money there, they sent money here, and then you know everything that has happened. So how does this work in this like verifiable way, this decentralized way? And the way it works is there's a blockchain network. Each computer can connect to this network, and these computers are called nodes. It's just a computer program. Anyone can run a node. It's just a computer program that you run on your computer, or some people run it in business, people run it on servers or in the cloud. But these nodes all talk to each other or talk to some other nodes. Not all the nodes have to talk to all of the other nodes. You only have to talk to some, and the information is essentially gossiped in this peer-to-peer way. And so I'll show you how this works to send a transaction. Well, first, you have to connect to the network, and then you sign your transaction, right? The signature is very important because we can't allow people to spend someone else's Bitcoins, so to speak. So once the transaction is signed, it's sent to the network, and it's sent to the peers that you're connected to, the nodes that you know about and are talking to, and then they send that transaction information to all of the other nodes that they are talking to, and so on. And then eventually, or alongside this process, what some of these nodes are doing, they're called mining nodes. They are competing to generate a block. That's the block in blockchain. So all the while, people are sending transactions, and miners are mining blocks. Basically, mining a block is just solving a computer problem, a math problem, a very difficult math problem. And so the first miner to successfully figure out the result of this math problem, they make that valid block, and they send it across the network the same way transactions get sent. But whenever one of these nodes receives a new block, the first thing that it does is it verifies that every transaction in that block is valid, meaning the transaction that we sent out originally will ultimately get made into a block, and then that block will get sent across, and that node, for instance, that iPad or whatever it is, will verify the transaction is correct, the person has enough money, or whatever is going on with that transaction. And then once they verify the block, they're like, oh, this is a good block, I'll send this to the network, just the same as the transactions get sent. If it's not a valid block, they just disregard it. And so you think this whole network, if most of the people on this network are cooperating and acting honestly, then any invalid data is just going to get lost. Everyone keeping up so far? Feel free to ask questions at any time, really. So you can see that eventually the new block makes its way across the network. Everyone has this new block. Yeah. Oh, yeah. So the way this works in a public setting, like look at Bitcoin, every time a block is generated, it awards a block reward, and I don't know what Bitcoin is these days, maybe 2.5 Bitcoin or something, where the person that solves the math problem first gets that reward.
So it's an individual person working to solve the block problem?
Yes, or it could be a collection of individuals that are sharing computing power. If you have 5 computers that are working to solve this math problem, that's mining. And so, I mean, in China nowadays, there are huge data centers that just have servers and servers and servers that are doing this mining. And it's lucrative because of this block reward. But also, and this is for public blockchain still, every transaction has a fee because, well, generating a block has a bunch of transactions. so miners have to choose which transactions they want to include. They're building the block, and so they see all these transactions going out on the network, and so they pick the ones that are paying enough to make it worth their while. And so it's kind of this, somewhere in here I have that. Yeah, so you get 2 rewards effectively. And the block, well, I won't get into that, but basically that ensures that every transaction that gets sent will sooner or later get picked up by a miner. It's like, oh, well, I have room for this cheap transaction. I'll throw that in now. Does that make sense? So there's also private blockchains which might not have a block reward. Companies might run their own blockchain that's for whatever they're using it for, supply chain logistics, maybe an internal accounting system. And you don't need to reward your participants because they work for you already and they're inherently incentivized to participate in this like block making. But for public blockchains, you do need this kind of incentive mechanism. Otherwise, the network won't go anywhere. People, it costs money to pay the electricity. It costs money to buy the computers. And so having these reward systems, it ensures that the network always moves forward. People are always incentivized to join the network and participate in it. Any other questions before I move on? So I talk a lot about verification because that's really one of the key concepts with blockchains is you have this ledger that anyone can view and anyone can validate. And so what does it mean to verify something? Well, you verify a block by making sure the metadata is correct, right? The hash, which I'll explain, the hash must be correct, the parent hash must be correct. All of the transactions have to be valid. And it has to point back to the previous block. It has to exist in this context of the blockchain. And so what's a valid transaction? Well, a valid transaction is really it has some rules, but mostly the big rule about what makes a transaction valid is that it is correctly signed. The person that sent it is the person that signed it. Beyond that, well, I've already shown you a failed transaction. Failed transactions are still valid, but the network just ignores them. But there's that transaction fee, so they're still included because the miner did the work of processing the transaction, so they still have to get paid. So a failed transaction is valid, but you can ignore it and pretend it didn't happen. So I mentioned hash a lot, and I'm talking about all this verification, authorization stuff. So I wanted to give a little bit of sense for some of the building blocks behind this. And I want to talk about 2 ideas. I want to talk about cryptographic hashes and public key cryptography. So a cryptographic hash, and whenever you see the word hash in a blockchain setting, it's talking about this idea. You have some function that takes any data and spits out a result. And so what's neat about it is you can't go the other way around. You can't figure out, if we go back a long ways, sorry. If you go back to the description of a block, it has this hash. What happens is you take all of these transactions and all of the metadata, and you send it into this one-way function, this hash function, and you get this value out. And then anyone that wants to verify this block will do the same exact thing. They will take all of the transactions and all of the metadata, and they'll hash it, and then they'll check it against the hash that was provided. And that's how they'll know that it's correct. You can't go the other way around. You can't take this and figure out what transactions are in this. It's just garbage data. But you can go the other way. You can you can have the transactions and recreate the block. And so that's kind of the verification procedure. Does that make sense? This idea is this is what links up the blockchain, right? Every block has all these transactions, all this data. It gets hashed, and it points to the previous hash. And the previous hash, that information is also in the block. That's also hashed. So you can see, you can recreate this in a verifiable way. Now, on the topic of people interacting with the blockchain, you need something more than just a hash function, something that you need something that can link back to the from address, right? If someone's sending a transaction, you have to be able to verify that it's theirs, that they signed it. And so you can do this with an idea that was invented in, I believe, the 1970s called public key cryptography. And the way it works is you generate, everyone that participates in the network generates an account. And the account has 2 components. It has a public key and a private key. And the basic idea is that you can use the private key to sign your transaction, and you can use someone else's public key to encrypt a message just to them. It's got this kind of symmetry to it. Like if I have your public key, I can send you a message. I can encrypt a message to you with your public key, and that message, the encrypted form, can only be decrypted by your private key. And so similarly, if you sign something with the private key, it can be verified with the public key. This is probably a new idea for people in finance. Does this kind of make sense? No? All right, let me try again. So you look at a transaction, and the transaction has a from address. That's a public key. And what you do is you take, let's say I'm this person, OXFC, whatever, and I have a transaction I want to send. So I sign this transaction. Basically, this means I do a bunch of math to it using my private key. No one knows my private key, but everyone knows my public key. And so I use a computer program that takes my private key and generates this signature. And what this signature can be used for is anyone with all of this information can say, oh, this signature for this transaction, this is from, I verify the public key is that. So it's like you already have the user's public key. The public key can be used to verify signatures. And you have the signature, you have the content, just like we were hashing this data in this consistent way. We can consistently reproduce and say, oh, with this signature can only be made by the person who has this private key. Better? Cool. This is probably worth investigation for people that are curious, because this is what our modern digital security systems all use. And if you don't want people hacking you, you should learn about security. So that's the math stuff. Let's talk about business. Let's talk about supply chains. So if people are familiar with supply chains vaguely, there's orders and shipments and status tracking of everything, and then you have to have accountants come in after the fact and make sure that all the things are there, and people have to take inventory constantly. Well, you could do all of this on a blockchain if you just say all of the things that happen are transactions. And so the user who wants to buy a product on Amazon can go and submit a transaction paying for whatever they're purchasing. And this transaction is verified. Oh, I see, it was signed by them. They have the money for it. It's a valid transaction. We have to fulfill this. And so someone in the warehouse will be verifying these orders and then maybe submitting new transactions to the people that are doing the fulfillment. And that transaction gets verified, and then they do the shipment. And so at every step of the process, you don't need to have these computer systems that are doing specifically handling Amazon orders or specifically handling orders for whatever. You just have this blockchain network, which allows any kind of transaction according to the rules of the network, and it just provides this like infrastructure for business to operate on. So with using this sort of technology, you don't have to worry too much about the accounting. You're not going to have a typo because the 1 million computers on the network are verifying every single transaction that happens, like all the time. And so you don't have this reconciliation role in accounting anymore, because you can just trust that every transaction is valid. Otherwise, you wouldn't see the transaction. It would get filtered out by this like mostly honest network. And so there comes the question of, what does accounting serve a purpose as? What purpose does it serve moving forward? And well, you can kind of think of accountants as taking a step back from this and looking at, well, maybe Amazon wants to use a private blockchain, maybe they want to use a public blockchain, maybe they want to use 5 different blockchains. And so accountants can take on this kind of advisory role of deciding which technologies to use and how they link up to maintain this like financial integrity. On the topic of what I was saying with you don't have to run servers, well, if you have a blockchain, the blockchain is this general purpose thing. You don't have to build these intricate systems. You can just use an existing blockchain, or you can copy an existing blockchain with little engineering effort. So there's much lower overhead if you want to just track the status of things. If you just want to track transactions, you can use this technology that's been invented. And that, in theory, would decrease this overhead cost of running a database that you have to keep online 99% of the time or whatever, because you have a network that's incentivized to stay online 100% of the time. Everyone's getting paid to maintain this network through the block reward. So through this incentive system, you're pretty much just guaranteed it's going to work. And like, in fact, the Ethereum network and Bitcoin, I believe they've had actually 100% uptime. And if you ever look at marketing material for cloud computing, they always guarantee 5 nines. Well, blockchains have like infinite nines.
Are you saying to use a blockchain system for business, you can save money compared to a traditional accounting system?
Sure.
Who pays for the rewards? And are you saying the rewards are cheaper than, say, the uptime of a typical system?
Yeah, well, there is that trade-off, right? So your question was about, I'll repeat the question for the recording. Your question was about the actual cost of this, because you have a block reward that has to get paid. Right. Miners got to get paid. Yeah, so that's probably where accountants come in, is accountants will say, why am I paying the 0.001 Ether in these transaction fees? And you might look, so a business might look at a private blockchain solution, which a private blockchain is maintained, all of the miners are part of your organization or part of perhaps a cooperation between multiple organizations, but they're all incentivized already. They don't need the block reward as incentive. And so you can have a private blockchain that you can guarantee its uptime because everyone involved in moving the network forward, they have these other incentives. They have, like, they want to keep their job incentives. So the overhead in this case would still probably be lower, just because there's been a lot of effort in the last 40 to 50 years of figuring out how you can have distributed systems. And so the blockchain and blockchain networks are one solution that provide this distributed ledger. And so rather than spending a bunch of R&D money figuring out how you're going to get all your computers to talk to each other, you can just say, oh, I'm going to copy the Ethereum blockchain into a private setting. And that's what people are doing. And so in that respect, I think the overhead is a little bit lower. Although it's still early days for the industry, I think we'll see kind of what the market prices are for privately managed blockchains are. But the other thing, if you do have a well-maintained private blockchain, other people could potentially use it. You could just pay, if Amazon has their own private blockchain, for instance, you could just say, hey, Amazon, can I buy a license to your blockchain? And then they can start sending transactions there. And they are incentivized to keep the blockchain going without the block reward. So, and I mean, you might as well trust Amazon. It's not going to go bankrupt, right? So there are options besides traditional accounting systems. Other questions before I move on? So let's talk about smart contracts, because sending money is great, but being able to fulfill financial obligations automatically, I think, is where the power of blockchains really get interesting. And so, yeah, given we have Bitcoin was the first blockchain, Bitcoin was the system where anyone can verify funds transfers very easily. But if you look, like, this is just a transaction. What's in a transaction? Well, a from and a to and a value and some data. And that data can be used to express all kinds of things. You could say, well, I'll get into examples in a second, but the idea here is, what if we can express our contract as just a bunch of rules and conditions? You have, I don't know, maybe an escrow contract. I'm holding money for this other person. There are rules that I would stipulate when I enter this into this agreement. I would say, I will transfer the money to you should this certain condition be met. So if we can encode these rules in a way that all of the nodes on the network understand, then these nodes can verify the transactions as they come in. The transactions follow the rules. The nodes verify that those rules are followed. And your ledger suddenly becomes more than just a bunch of money transfers. It becomes a system to keep track of the state of each contract. Maybe an example would help. So let's look at one simple smart contract, which would be a multi-signature wallet. Let's say there are 5 business partners, Alice, Bob, Caroline, David, and Eric, And they agreed that they want to have a shared account for sending money. They have a bunch of crypto assets for whatever business purpose. And they agree that funds will leave the account if 3 out of 5 people agree. So you could imagine what the rules for this would be. Maybe one person starts the transaction and 2 other people have to agree, and then the funds get sent. And you can imagine, I mean, the rules for these smart contracts are written in computer code, but you can translate, business logic into this computer code. And so if you look at what the transactions look like, imagine each of these transactions is in a block somewhere, and they happen at some time. But to start, you create a transaction that says, make this contract with these rules. Let's say Alice does that. And so now anyone on the blockchain can verify that this contract exists and what rules it has, because they have the transaction. And they can just replay the blocks and see, oh, there was a transaction that created a contract. And so the second transaction is to the contract itself, and it says, I want to spend this money, we got to pay rent. And this transaction goes on the blockchain, and the blockchain verifies, or the blockchain updates the state of the contract. We have a transaction request with 1 sign-off.
So this blockchain or this block will have 1 signature or 5 signatures?
Well, in transaction 2, there will be 1 signature. These transactions might be in separate blocks. I mean, they could be days apart. The blocks themselves are just a way to organize the transactions. Really, what we're interested in is the transactions. The blocks don't really matter. We just want to know what's going on. The blocks are like a package of transactions for the network to use. But if you want to just think about this as a financial system, you only care about the transactions. So after the second transaction, which is the first for for paying rent, Bob wants to pay rent. He's like, guys, it's the 12th already. And so Bob sends a transaction to the contract to say, we have to pay this rent, and then Caroline goes and approves, and then that's the second sign-off. And then someone else, one of the other 5 partners, David, for instance, will say, yes, we do have to pay rent. I also approve this transaction. And the result of this transaction is we would have all 3 out of the 3 required, and so the funds at that point would automatically send. And that would be encoded in the transaction as what happens. And then it'll just update the balance. Like that's the result of that transaction is this wallet's balance will be less, and someone else's balance will be more. And when you connect to the network and you look at all of the things that have happened, all of the transactions, you'll see, oh yeah, someone made this smart contract to spend money together, and now these 3 people spent money together. So in order to do this, you actually have to keep track of everyone's account balance as you go. But you could throw this away, right? If you have a ledger, I'm not an accountant, but you have a 3rd column, I guess, which is the balance of everyone. How does a ledger work, right? But so what all these nodes do on the blockchain is they keep track of everyone's account balance. They keep track of the state of every smart contract. So that smart contract for the multi-sig wallet, that has the number of signatures that have happened already for a particular transfer. And so all of this information is kept alongside the blockchain so that it's fast to look at. Anyone that interacts with the network can say, oh, they're still waiting on a 3rd transfer authorization. But if this information gets destroyed, if you connect to the blockchain for the first time, it's very trivial. You just go block 0, block 1, block 2, and so on, and you recreate it. Does that make sense? This is why we can trust the data, because we store the things that happen separately from the result. And the result of what happens can actually just be discarded because we can recreate it easily. Questions before I move on? Okay, I don't know what that's like.
That's
Yeah.
a bit of more of a personal question. I kind of came in late, so I had class. But everything I've seen so far kind of points to that Ethereum blockchain. Is that like your personal favorite?
Well, so the company I work for builds development tools,
Okay.
and we started on the Ethereum blockchain. So it's the one that I'm most familiar with.
Okay.
But most of the concepts, I believe, apply across blockchains. I mean, Bitcoin doesn't have smart contracts, but
They don't have ERC-20 tokens.
We can get into what those are if there's time.
Yeah, let's talk about it.
Oh yeah, happy to help. So here's where I reveal myself to be a futurist. Let's talk about robot businesses. And there's one project that I've been interested in lately that's run by an organization called MakerDAO. DAO means Decentralized Autonomous Organization. I'll explain what that means. But basically what they're trying to do is they're trying to create a cryptocurrency that is $1. And it stays at $1, despite what the market does. And so they've created a system of financial instruments, like derivatives. They're actually debt positions. They have smart contracts that will allow you to open a debt position. Basically what you do is you put some Ether or another crypto asset into a smart contract, and then you can create dollars out of thin air that are backed by your Ether. And as long as you have 150% the value of it's called DAI, is the dollar token. As long as you have 150% of whatever DAI you borrowed backed by your Ether, then you're safe. You can just spend the DAI. So you can go and you can send 10 Ether to this smart contract and make, I don't know, 500 DAI, and then you can go and spend that DAI. And eventually you'll have to pay that. If you ever want your Ether back, you'll have to pay off the DAI. You'll have to pay off the debt, like the 500 DAI that you created out of thin air, and you'll also have to pay some interest. And so this is all well and good, but why is the DAI actually worth $1? Well, it's backed by an equivalent value, more than the equivalent value in the underlying asset. And if the price of Ether ever drops, then your loan gets liquidated. The Ether that you had in escrow gets used. People on the network, selfish people, will say, hey, that loan is at risk. I'm going to liquidate it, and I'm going to buy the loan, and Maker gives you a discount for doing that. And so you have this system where if the price of Ether ever drops, all the loans get liquidated, or some of the loans get liquidated, and that DAI disappears. And so you have this system of supply and demand where there are well, I guess I'm getting ahead of myself. So yeah, I was talking about just the participants. The people that open these debt positions, the debt positions are called CDP, collateralized debt position. There are also price feeds because the blockchain has to know what the value of Ether is at any point in time. There are liquidators. These are the people that are selfishly acting to buy discounted Ether. And then there are also Maker holders because the interest for this system is paid in Maker. And what happens with that token is it gets destroyed. So the idea is if the system works, then the people that hold Maker tokens will gain value because the interest just destroys the token. So supply decreases. Where is that on this slide? Yeah. They earn value through the interest paid, right? So the interest gets paid in MKR. That MKR gets destroyed. So before that happened, there was maybe 1 million Maker in existence. And now there's 980,000 Maker in existence. And so suddenly everyone has whatever percentage more, because if supply decreases and demand stays the same, then price goes up. I know something about finance. Yeah, so the idea here is that by making these smart contracts, you can create a digital asset that is backed by a volatile asset in excess, and you can just guarantee that there will always be this way to get that escrow back out, either through this liquidation system or just by paying off your loan. And because this guarantee is so strong that anytime the network starts trading DAI above or below $1, it's like, oh, I could sell my DAI for $1.05. I'm going to do that. And then that'll drive the price down. And then, if it gets to 96 cents per DAI, it's like, well, that's a steal. This thing's going back up to $1. And then it does. And so you can just use this distributed, verifiable system of smart contracts that's not really managed by anybody. Maker holders vote on interest rate and things like that, but it's just robots. Robots reporting the price of Ether. Robots liquidating people's loans. And suddenly you have this asset that you can trust is $1. So that's pretty neat. Hopefully that shows.
Well, all right. Okay. So preliminary, it looks great because it looks like it definitely is better than the BTC tether. That's
Sure.
What the tether is. That's the role of the tether. But let's being real and just being honest. The tether works because BTC right now is king Bitcoin. So
Yep. Yeah, I mean, there will still be use for Tether. I mean, present this as kind of a case study because I think it shows the power of smart contracts. There are other stablecoin projects, and there has been quite a bit of discussion about, like, is this actually a good way to build a stablecoin? And I mean, the DAI has been stable since December when it launched, but that's not really enough time to know if a currency is going to hold its value. But I mean, the ideas of using these like inherent market forces to kind of force the system into this feedback loop.
What was that ICO like?
It was one of the first.
Do you know how like the range that they
I have no idea. It was not. They're like one of the original Ethereum projects. So they did an early ICO, probably didn't get anywhere near as much money as some of the others did.
And they're still around though. They're still around. Right?
Oh yeah. Now I mean they're working on.
Okay. Well, that's actually good though. Okay.
Yeah. So it's I guess a project that people in the space talk about a lot because they took their time. I think they developed it over 3 years, hired a bunch of economists and things like that, and pursued it. And we'll see in 10 years maybe if it works. So I wanted to talk a little bit about decentralized autonomous organizations. And so that's why I mentioned MakerDAO. MakerDAO is such an organization. There's no business, there's no legal entity. When they raised money in their token sale, it was just sent to a multi-sig account. And people in this organization developed these smart contracts, and they're just taking money from the multi-sig account in crypto. And there's no government entity that's backing this as a business. It's just a smart contract. It's just a set of rules that people who are all selfishly incentivized to do whatever is best for them are working together, voting on interest rate however they want. Like people that hold Maker choose the interest rate, and well, so they're incentivized to choose the interest rate that will make Maker valuable for them in the long run, much like a publicly traded business would operate. You have a board of directors that have shares, and they represent the shareholders, and so they want the share value to go up. So they take executive action in hopes of making the value of the company increase. Just like holders of Maker in this example want the value of Maker to increase, so they take action according to that interest. And besides that, then it's just a bunch of people connecting their computers trying to liquidate at-risk loans, which they get paid for. And so they're incentivized to participate. And this blockchain network under the hood is doing all of this verification to make sure that every step of the way, all of these participants are following the rules. Does this make sense? Any questions? Cool. I don't know if DAOs are going to be a thing. I mean, there's something to be said about being able to take someone to court, but maybe in the future we'll see arbitrage smart contracts or something like that that can take some of the, I guess, pressure off of the courts. So that was the end of my presentation, I guess. So the idea is that we can build these trusted financial systems, but we don't have to trust anybody. We don't have to trust anyone in particular except trust that they're selfish. And by setting up the rules of network communication, like all of these computers talking to each other according to these rules, if the rules are correct, we can have a system that is ultimately trusted en masse, even though everyone's just trying to look out for themselves. And so hopefully that gives you kind of a sense of what this technology is about and how it can be useful and how it can improve business operations and even like invent new kinds of finance.
I have a question. So I took a course, so I learned that it's a blockchain. Once it's a block made, say it's the original block. It stays that way. Is that correct?
Yes, the blocks never change. And they can't change because if we look at back here somewhere, the block has a hash. I talked about cryptographic hashes. They take all of this data and they generate this hash. So if you try and change any of the data inside the block, it would have a new hash. The hash would be different. And since every block points to the previous, you can't change one in the middle because then the next block is going to point back to the previous one and it's going to have a different hash. That hash is going to be what it used to be before you tried to change it. So is that, so that,
No, just so that, once it's there, right?
mhm.
And you can add to it, but you can't change it.
Right. Yeah, you can always go forward with a new block. So technically, let's say half of the network doesn't hear about this block, and 2 blocks are created at the same time. Well, then the networks have to figure out how to agree over which is the next block. And so for a time, the network will be split, building blocks on this one and building blocks on this other one. And so the network has rules for this. It's called the longest chain rule. If any block gets out ahead, let's say this, like it splits off here, and this has 5 blocks, and this one only has 3, then this other one would win, and that would become the blockchain. So the data can change, but only so far as you can get a longer chain ahead of it.
So is that what Bitcoin did with Bitcoin Cash and Bitcoin
So Bitcoin Cash and Bitcoin,
when they forked?
yes, in effect. They had, at some point in Bitcoin's history and Bitcoin Cash's history, the 2 chains had the same history. Up to some particular block, that was the last block in common. And on the regular Bitcoin network, the next block was a particular block, and on Bitcoin Cash, it was a different block. And from that point forward, they were entirely different. And this is a split because the blocks aren't compatible. They run different software. So what is valid to Bitcoin Cash is not valid to Bitcoin. And so
What does that mean?
what it means is you have 2 blockchains, effectively.
Coins.
2 coins, yeah.
That could happen with blockchain too, or just with Bitcoin?
With every blockchain. So this happens because people have to make software updates. They find bugs. They want to add features. Like Bitcoin Cash tried to be a faster network, right? And so they decided they were going to update their software at whatever block. Let's say block 1 million. Starting at block 1 million, we're going to support transactions that work this other way, this faster way. And all of the old Bitcoin software that's like the regular Bitcoin, it doesn't understand that. When it sees that transaction, it sees, oh, it's invalid. And so you effectively get 2 networks from that. You get, I mean, they have the same like history at some point, but after that point, different rules, different network, and different blockchain.
Let's get to the nitty gritty, my man.
All right.
Are you a fan of XRP?
I don't have the time to do investment investigation.
No, I'm talking about literally as far as, because I consider myself like a crypto purist. I mean, I even read the white paper on Bitcoin, had no clue what it was when I saw it years ago. I don't like anything centralized. So that's why, and I'm just curious, and I ask people who are in blockchain, I literally ask everyone just to kind of see, just get my own little general consensus.
Yeah, I'm into the decentralized systems for sure.
Okay.
I mean, I see the use of Ripple because you might be able to appeal to banks, but my hope is that eventually the public blockchains will be, cost effective. Yeah, support enough transactions to actually be usable. Like a bank's not, what does it cost to, it costs like $72,000 to store a megabyte on Ethereum. You're not going to use a blockchain to store data, but transactions are still, I don't know what they cost these days, 2 cents, something like that. A bank doesn't want to pay 2 cents a transaction. Maybe they do. I don't know what it costs a bank to operate, but you can't send that many transactions, right? The price will go up if enough people try and send transactions, and then you can't use it for real business.
It's new to me and seems very complex. I have a limited understanding, but I mean, gaining trust in something like this, it's not hackable. None of this is, how does a business decide to go into this and with the complications of it, digital signatures, private keys can get shared, they can get,
Yep.
and now all of a sudden my trust in this plummets, and that makes me worry about if it's a financial system,
Yep.
Can you give me a sense of that, it's not hackable, it has its redundancies?
So it is hackable. If you look at this blockchain, all you have to do is buy enough computers that you can generate blocks faster than the network is currently generating blocks. And you'll start making your fake blocks alongside, and eventually, since you're doing it faster than everyone else, you're going to have the longest chain. And then everyone's going to look at those blocks and see them as the canonical source of truth. And so this happens, this is what's called a 51% attack. If you have 51% of the computing power of the entire network, you can basically say what the blockchain is. You have the entire control over what blocks you are generating.
And then all the transactions of the past are invalid, or I mean,
They're not invalid, no, and in fact you still have to generate valid transactions because you might have 51% of the computing power, but you still have a network of computers that are all verifying every single transaction. So it's not entirely hackable. You still have to generate real transactions, but you get all the block rewards yourself, and you can omit transactions, you can censor transactions, and that's a big area of where you wouldn't want it to be hacked. But the upside is you can calculate the cost of a 51% attack. You can look at the Bitcoin network, look at the computing power that is currently being used to run the network, and you can just say, how much would it cost me to buy that many computers, 51% of those computers? And so it's hackable, but it has a price tag. So if you're a business that's looking to use blockchain technology and you're considering whether you want to use a public blockchain, you just look at the cost of doing a 51% attack and you decide if that cost is comfortable enough for your, but right now, I don't know. Countries can afford to break Bitcoin right now, but I don't know. I'm sure big companies could also break Bitcoin if they really wanted to, but that's why we have private blockchains in the meantime.
So my understanding is this was why accountants need to get into this space and look at the different private blockchains and who's doing what, who's running them. Did they just copy the names and faces and post them on their website or on their coin or whatever when they started it? So the accountants need to get higher level thinking. So they can be advising the company, so that companies, if you're talking about your company, can trust, because CPAs are the most trusted individuals in the world, I've heard. And being one, I'll go with it. And my son doesn't, but. But I think that's where the accountants can be a big play.
Right. Oh, yeah. So blockchain and security have gone hand in hand. Like Bitcoin was formally proved to work as like a distributed system. There are ways you can mathematically prove that the network will always advance, that the network will never be inconsistent, or eventually it will be consistent. And so you can prove these things. And so that's at the very core of the design of these technologies. And so that affords some degree of trust. But yeah, I think to start, nowadays you would probably want to use a private blockchain if you're a company like Amazon or a very large business that does a lot of financial activity, because for a private blockchain, you can set up firewall rules and other internet security rules like we've been doing on cloud systems, right? And so you can make sure that no one else has access to your blockchain. And by just like preventing them from even connecting to the network, you can have this additional assurance that it's not going to be hacked. Does that give you a sense?
yes, thank you.
With considering security, though, I'll say that for any business security or even personal security, there are always trade-offs, like private keys being shared. If you're a business and you're starting to use private keys, you have to figure out your operations so that people are not like, oh, just use my private key that uniquely identifies me, and now, all sorts of havoc can be wreaked. But yeah, so there are trade-offs, right? And so pursuing any technology choice, you have to consider those trade-offs. And accountants can do that.
Well, I want to make sure people understand what a private key is.
Yeah, so a private key is a piece of data. It's a really big number. It's just a really big number, and it identifies you, and other people can't guess it because it has like 100 digits. And so I'm thinking of a 100-digit number. Can anyone guess it? No, I don't. I mean, it would take you probably billions of years to guess it. So this private key, because it has a corresponding, where's that slide about that? Here. So like you generate a private key and you have a public key to go with it. The private key The public key is your identity. It's what you can share. But anything that you do as that identity can only be done by the corresponding private key. And so, I don't know, if people have iPhones, use iMessage or WhatsApp or any of these, or Telegram. There are a bunch of encrypted chat services nowadays. They all work with this idea of public-private key technology. You have your device, you install the app on your device, and it generates a key pair for you when it starts up. And then you start talking to your friends, and every single message you send gets encrypted with your private key. And when your friends receive the message, they look at it. Well, it gets encrypted with your friend's public key. So I send a message to my mom, and it's on an encrypted channel. I have her public key. I encrypt a message with her with her public key. Only she can decrypt it. She can know it's from me because maybe I also signed the message, and so she has my public key, and so she can look. I signed it with my private key. It's this like symmetric thing, right? Anything done with the public key can be undone by the private key. Anything that can be done by the private key can be undone by the public key. And so if you're only sharing one of these, you share the shorter one usually, not the 100-digit number. But yeah.
And what happens if you lose that private key?
Then you better hope that your public key was not in any meaningful way associated with your identity.
Well, what if you're using it to buy currency?
Then you will lose your currency very quickly.
Well, I just want to make sure people understand.
Yeah, so
They're very basic here.
yeah, with blockchains, you can't go to the bank and say, I lost my debit card, I need a new one. You have to think about good storage of these things that, I mean, everyone's heard about identity theft. There's a big market for people doing malicious things on computers. So if you're generating a private key and you're going to use it for something valuable, whether it's your Bitcoin stash or your identity, I mean, maybe I'm just like keeping a journal and I'm signing every entry in my journal. I don't know why I'd put that in a public sphere, but like then someone gets my private key and they start adding log entries, and this person, this public account that's been identified as me for its entire existence is suddenly saying some other stuff that I don't want attached to my name, but too bad. They got my private key. So yeah, if you're using these technologies, you want to be very sure that you're not going to lose your private key, that it's not going to fall into someone else's hands. Yeah, be
It's
careful.
also managed by signing, digital signature authorities help you manage that.
Yes, so public blockchain networks don't have that right now because, well, who is going to be, I mean, the whole idea is you don't have a trusted third party in a public blockchain. So in a company setting, then that might be fine. You have, you issue private keys and then you can revoke them later. And so every time, instead of just use the public key to decrypt the private message, you have a third party and you need to get both sign off. You have to use both to decrypt a message or both to confirm the signature.
Question. So I just posed this question actually on my home group. So, and I asked everyone, it seems like right now everyone is definitely more focused on just finding those right projects to get rich quick instead of focus on like, mass adoption. So I told them, like, basically what I posed in the question was everyone in our group, y'all more focused on like finding the right coin instead of, for example, like Exodus, HTC, to come out that Exodus phone, the Lightning Network is going to be on the phone. So, I put in an order for the phone. So how do you think, and just this is your opinion, but how do you think we can try to contribute, get people from focus on the value to more about mass adoption that will then in turn create that value that we're all looking for?
Yeah, I mean, I make development tools for a living. So I heard someone say one time, in a gold rush, the person that makes the most money is or the people that make the most money in a gold rush, selling shovels. So, I mean, I don't know. I'm a technologist. I'm interested in this stuff from a technology perspective. So, I mean, I'm inclined to buy cryptocurrencies where they look like they have a good sense that they're doing something new, right? Because anyone can make a coin. It's just a smart contract on Ethereum. And you can just tell people to buy it, but why should I trust that? And you could copy Bitcoin and not do anything different, but why would you use it? And that's because of the network effect. So anything, if I'm going to buy someone's, what is very closely resembling a security, if not actually a security, like I want to be sure that it's a sound investment. none of these tokens are, I don't know if these tokens are securities or not. This is not investment advice. My company insists that I tell you this probably every 5 seconds. Yeah.
Yeah, everyone needs off with that disclaimer.
Yep, well, you know, better safe than sorry. I don't want to get sued. I'm just trying to teach y'all. Cool. I think we're at our question and answer time, so keep them coming.
Are the transactions correlated? Like, do they go to one specific goal, or are they just random transactions?
So a transaction that sends money is just from a person to a person. Anything.
Not a subject, not for a project.
Well, you can have data. So if you look at, how do I get back to the beginning? Yeah, right here. If you look at the parts of a transaction, there's that data field. And so that data field can be used to associate it, like if you write a check, no one writes checks anymore, but if you write a check, you would have a memo, and then that data could be used for that. And so that's how you could track it. Or that data could be information to a smart contract. Like in the multi-sig wallet example, the data might say, this is for rent, and the to address, when that first transaction, to field for this transaction would actually be to the smart contract itself. Like every smart contract gets its own address. It acts just like a person. It has its own money. So there will be money in there. And then this transaction, Bob sends a transaction to that contract, and they might use that data field, say, oh, it's for rent. And then, you know, Caroline and David come along and they look at it and see, oh, it's for rent, and they approve it. Does that answer your question? But yeah, but beyond that, the transaction could be just for any purpose. It could be entirely random. Oh, I should talk about data analytics. Peter asked me to talk about that. I didn't make it into my slides, but a key idea of this blockchain stuff, you have a history of every single transaction that has happened on your network, and you can just replay it, and you can look for trends, and you can look at what's the most popular smart contract. You can look at what exchanges are people using. Like, you can do all kinds of data analytics on this because it's a public record.
So you said that the public blockchains are like based off like a reward of Ethereum.
Yep.
Isn't there a limited number of Ethereum
Yes.
out there?
Where is it?
What happens after that, like, you know, that number gets reached? How are they being rewarded still?
Transaction fees.
Oh,
Yeah, so Bitcoin is designed, Ethereum doesn't have a actual issuance model. I mean, it does, Ethereum has had the block reward decrease a couple times, but it doesn't, like Bitcoin has a graph that you could see. It's like, this is how many Bitcoins are going to exist at this point in time. And there will never be more than 21 million Bitcoins. The hope, or the theory, is that once those 21 million Bitcoins have been issued and the block reward is negligible, that people will be using the network and paying transaction fees, and that will be enough incentive.
With Ethereum, like he brought up Ethereum, wouldn't it not matter as much since, I mean, they're planning on going proof of stake, so wouldn't that be different in a sense?
Yeah, well, that transition just means they haven't had to really answer the question of how many Ether will there be at a point in time, because there's like software updates to be done before people can figure out the economics of it. But they do. I mean, there's a hard fork coming soon, the Constantinople hard fork that decreases the block reward on Ethereum. So, I mean, they do think about it a little bit. I remember Vitalik Buterin's original economic ideas for Ether was that it would be a disinflationary currency. Bitcoin's deflationary. It's designed to lose value over time, or increase in value over time. Disinflationary means it's designed to be more like a fiat currency in that it slowly loses value, but the disinflationary meaning the amount that it loses value over time decreases. I don't know. Talk to a crypto economist if you want to know more about this stuff.
Is the idea that you can craft a blockchain for a particular business's purpose?
Mhm.
Like different ones will be structured, whether it's accounting need or other need, banking need?
Sure.
And they're customizable? Is that?
Yeah.
You build your own, is that as a developer or builder of developer tools, is that what you do, is you make this technology accessible for the right purpose?
Yeah, well, I work more at the application layer personally, but my company Truffle is expanding to look at, I guess, strategic partnerships with various businesses to look at their particular needs. But our tools are mostly for application developers to build on top of a blockchain rather than actually build a blockchain for you. But yes, you can customize them. I mean, just because one blockchain has like whatever fields are in a block or a transaction, like you can have other fields and you can have different rules that the network will follow. And so, yeah, but that on its own, like even just having, you know, a bunch of cryptographic hashes from a to value in data, that's pretty powerful, right? That's, I mean, what are accounting ledgers? They have debits, credits, and totals, and then like a line item for saying what it is. Like there's a lot you could do with that little data. But yeah, it can be customized. What people are more doing for the customization that I've observed is they're looking at the consensus mechanism. Like on Bitcoin or Ethereum, you get a block reward. Who gets to decide on the next block in a private blockchain? Do you have like a collection of computers that are authorized to make the next block? And so they're all different manners of, like they call them consensus mechanisms that could be used to determine who makes the next block in under what situations, like who has what authorization. And so that's where I see more of the private blockchain stuff going right now.
What I know you just said that you were more on the applications, but what language is the Ethereum network on, and why did they choose that?
Well, there's the Ethereum virtual machine, which is like what the computer code runs in. Like if you create a contract, that contract is written in EVM, but there's a high-level language that you've probably heard the name of called Solidity. But that's separate. That's just, it could be entirely separate. You can have a high-level language that more closely resembles like human thought, and you can take code that you express in that high-level language and compile it down to EVM. They're using the EVM, to answer your question directly, they're using that because they realized, the original creators of Ethereum realized that they needed something other than a PC. Like the PC has a particular computer language. Yeah, well, at the base of it, it's just binary. But it's how that binary is structured. It's like, what's add, what's multiply, what's conditional. But yeah, so the Ethereum has its own right now. They're working on changing that to what's called WebAssembly, which is a standard.
And they're leading with developers, right?
Oh, by far.
By far.
Yeah.
Is there any recourse if someone sends the wrong amount or sends a payment twice for them?
Well, you can't send well, I guess if you have enough money, you can send a payment twice.
Forgot.
Yeah, no. I mean, hope you know the person. Hope they're nice. Maybe in the future we'll see smart contracts that have like a timeout period where you can send funds and then reverse the transaction. But it's like that's something the Visa network gives us as a way to do this like back channel transfer cancellation. But no, the whole point of the blockchain is you can actually guarantee that you'll get the money when it's sent to you.
While I was on, do you know any top developers like on the Ethereum network? Not personally, but just by name, so I can follow.
Yeah, I mean,
Or like any new guys, I got everyone. I got a list at home. I got anyone that's been on.
yeah, I don't know. I mean, who's been active on Twitter lately? Well, like Simon Della Rouviere, he invented token bonding curves. Or no, he's doing a lot of research on token curated registries, I think. I don't know. Search for crypto Twitter.
Okay, yeah, that's
Yeah. Yeah, I don't know who's famous because, I mean, I work with a lot of them, and so it's like, but.
I just want you to define permissionless and permissioned.
So a permissionless blockchain is like a public blockchain. Anyone can make a smart contract. Anyone can participate in mining. Anyone can send a transaction. A permissioned blockchain is a private blockchain. It has rules of some kind or another about who can do what. Maybe it has a special system of giving out private keys so that you don't so it's not a huge problem if someone loses their private key, right? And so those are terms you'll hear a lot. That's probably why, yeah. So if you hear permissionless blockchain, you could just think public blockchain. If you hear permissioned, you could just think private blockchain.
So, like, this is my first time, like, hearing most of these stuff. Like, I've never used or worked with cryptocurrency or anything before. What are some of, like, the easiest ways to, like, get into it or learn more about it?
I mean, if you're looking at cryptocurrency specifically, I mean, go to Coinbase. I'm sure they have a lot of resources to help you understand. I mean, are you looking for like an investment perspective or?
Yeah, like that, and just getting more knowledge on like blockchain.
Yeah, I mean, I don't know. I used to just like read Reddit. I mean, this guy over here probably knows a lot more than I do about how to get started with this stuff.
I'll say it now, YouTube, you just gotta follow, like, that's why I asked them about the developers, follow the developers. I mean, you go to Barnes and Noble, find some Bitcoin books, just find, like, look at the people name. I literally went there one day and started writing down names, go follow them on Twitter, go follow them on social media, and they start talking. It's like, that's really, like, so people, just a little tidbit, when you follow the developer, like, people wanna make money with crypto, if you follow developers, you're gonna be leading, you're basically gonna be following, like, the breadcrumbs to the bread, like, to the money. But yeah, just YouTube. Coinbase got everything, and use your phone. Like, I got, there's a whole bunch of apps. You go to the app store, there's like a whole bunch of apps that just got everything for you. It's really at the fingertips now. Just for everyone, you just gotta go look for it, you know, seriously.
Good developers doesn't necessarily mean you're going to get rich, because the things that some of these projects are trying to do are very challenging. And so even if the project looks really good, it could crash and burn.
Yeah, they may never achieve it.
Yeah, like I mean, with Ethereum, we're waiting for, they're trying to change their underlying consensus mechanism. They're trying to make it more scalable. Seems promising, but, you know, do your research for sure.
I would just say, they were saying for people to look up, to learn, I would say like Andreas Antonopoulos.
Oh, yeah.
One
Mm-hmm.
of the top guys, I would say.
Yeah, he
For research.
yeah, he does a lot of like public engagement type of stuff. I mean, Vlad Zamfir also, I mean, he's one of the core Ethereum developers. Nick Johnson. I mean, just look for core Ethereum developers. I mean, they often argue on Twitter a lot, I see. I don't know.
How about you, Nick?
I'm really bad at tweeting.
And answering text, too.
Oh, yep. Well, I'm busy building things. Actually, I'm busy standing in front of audiences mostly these days.
We appreciate you coming.
Oh, I'm happy to do it. I love teaching people. Hopefully I've taught something. I don't know. I'm used to talking to programmers also. Cool. More questions? Oh. Thank you very much, everyone.